Welcome to the coffee shop, everybody. This is your host and barista, and we are up to lesson number 8 in this lesson plan. This was an entire lesson plan that was done with a trading group called Trade with Confidence. Link to their Discord is in the description below. And today, I'm going to show you how to spot reversals using the Heikin-Ashi Algo version 6. Put it on your chart. Link is also in the description below. Let's go. The close of the candle is beyond this swing, right? Beyond this low. So this is where the majority of the resistance should be. If I'm trading back in this direction, then this should be my limit. I don't want to go beyond this. That's it, right? And that's simply determined by, right, what's happening here. That's it. The RSI closes through the candle. The candle is smaller than the previous one. You have a doji candle here, right, inside the range of the previous candle. Understanding a little bit about price action, you can see that you have a support level here, and you're already beyond that a little bit. Maybe you have another one further back here, whatever the case may be, right? Everything is telling you that you are bouncing off of something. And the algo is telling you, in your short term, if you want to use this simply for scalping up and scalping down, it's automatically telling you where your reversals are. And that's simply by looking at where's the candle, on the low side or the high side, okay? I have a low side candle, a bearish candle on the low side, but the RSI is moving faster in the opposite direction. Start taking longs. Okay, great. Now, I said that the RSI should be ahead of your candle, correct? Here's a bullish candle, RSI is ahead of it, bullish candle, RSI is ahead of it, bullish candle with no wick, okay? That's a trigger. It's got no wick. It needs to have a wick, okay? I prefer it to have a wick. That means it has a high. If it doesn't have a high, then you don't really want to deal with that candle. You want to look at the ones with the highs. That's your trend. No high means no trend. Heikin-Ashi candles. High means trend. Low means trend. No lows means no trend. No highs means no trend. Okay? So there's a few things to take into consideration. And when you're working with a 1 minute chart, you're fine. Okay? It seems like a lot to figure out on the fly, but it really isn't when you get used to what it looks like, you know. And this helps you, okay, so how would something like this help you? Okay, and I don't need to draw it out, but you can already see you get this reversal right here, right? Candle is smaller than the previous one, the RSI closes through it, and right here it's basically saying market's going to start pushing the other way. Great, you know, start entering your short at the close of that candle, right? Or you entered somewhere during the formation of this candle. Find your support. Where was the last high? Like here's a high. Let's get rid of this. Here's a high. It was broken by this candle. This open is going to be my target. That's it. That's going to be my target right there. However many ticks that is. And in this case, it's on gold for 68 ticks. Okay. Now, there we go. There we go. So how does this help you? Well, you could simply look backwards, right? Let's say you're in your downtrend and you only want to find continuations in your trend, right? You know that you're in a downtrend now. The uptrend has finished. You're in a downtrend. When is your pullback over? Okay, this is literally showing you when the pullback's over, right? You got out of your trade. These candles form. You get a cross. Now you can start getting back into your short-term, your current trend, right? Go back in here. Then you get this cross. You get a cross again, right? And you can start looking for support again. And this is the importance of finding candles that break swings, okay? You can see this short move takes place here, right? And this is your entry to scalp back in your direction. I get it. There's not much movement here, but you have to understand why there's not much movement. Look at this candle. This candle breaks above this, right? So you got support here. This open breaks above this one. You've got support here on that little business right there. Okay. Take into consideration, like I said, the wick is the most resistance, right? Watch for those zones. Got to watch for those zones. Absolutely got to watch for those zones. Now, the other reason, a secondary reason why you have to be careful about this reversal move is this candle is smaller than this candle, you would generally want one that's bigger. Generally, you want one that's bigger than the previous one. That means there's more spread, right? More movement, more volume, whatever the case may be. So, and that's how you find reversals in this little business. Having the average on here helps you out a lot because you want to know if you are trading above or below average. Okay. If you're trading shorts, you want to be below average. And this is, you know, this is going to be very dangerous to go into. Now that I have the average on here, I should have had it on here earlier. So you're still closing like bullish, but you're above average. If you're trading bearish, you want to be below average, obviously. So, so my apologies. I should have put that 14 period moving average on there before. These would have been the better ones to take for your continuation moves, not these, because your average is rising and you're not closing. Your RSI is not closing below average. So let me just go right there. And so there's your reversals that you can look for. To get reversals, terminations. Here we go. I've met a number of people that use the RSI, that use the algo. They simply use it to find a trend that's over. So they set this at 9, or they set it at 7, right? I think they set it at 9 or 7. Let me find out. And they set it for regression, okay? I think that's what they do. No, yeah, that's right. They set it at 14. That's right. Okay. And what they're looking for is if they're in a downtrend, right? If they're in a downtrend, they want to find out when they're just trying to keep the candles inside. That's all they're doing. They're just trying to keep the candles inside that little envelope there. That's all they're doing. So if they're trading shorts, they don't want it to close, they want it to open and close inside the envelope, right? Open and close inside the envelope. They're literally just taking these little candles here. This one they'll take, and they'll find their take profits. Just very small. Obviously, I'm on a 10-second chart, so there's not much spread taking place here. For example, like this one, they would never take that long. They want to see the reversal, right? They want to see the reversal. The next one takes place in the envelope, and they just enter and exit. They see the reversal, right? They're looking for when opens and closes. None of them here, and none of them here, right? None of them here. They're looking for the open and close inside, and then they're just taking those reversals using a regression. So the reason I'm talking about this one is because somebody in the group asked me some time ago, when do you use this? A linear regression is literally trying to show you where is the zero value, right? What's the mid value that you want to get back to? So that being said, in an oscillator, if you're in a downtrend, then your mid value looks like this, okay? It's not flat. It looks like this. So what you're looking for is, let me do this. You've got price moving like this, right? Your mid value, you hit it on your way up. Now you're trying to hit it on your way down, okay? That's all you're trying to do. Your entry would be right there. So if you're crossing your moving average when it's set as a regression and you're crossing it on the way down, that's when you want to be able to get into your trades. You want to be crossing through that. There, right? You don't want to exceed the RSI. You hit this one, not the next one. You got to cross through it here. It says that you cross through it there. You cross through it, there. Okay? And it's these really small moves that they're taking. That's all it is. So if you're in a downtrend using regression, you want to catch it on the cross down, not the cross up. Let me wipe all this out. There. Okay. Carlos asks this question a lot. EMAs or SMAs? Which one is better and why? Okay. A lot of new traders will go and put an EMA on their price chart all the time, right? And you got the options here, EMA and SMA. I prefer SMA when you're dealing with, precious metals. It's easier for me to say when to use EMAs, in my experience. The best time to use EMA is when you're on really small scalping time frames, 5 minute and less, and you're dealing with something that has high volume, okay? What has high volume. let's say that you're coming into the New York, I don't have it over here. Let's say you're coming into New York session, right? Don't know where that is right now. Let's see. Yeah, say you're coming into New York session. So volatility is going to really start jumping off, right? Let's say 9 to 9:30. Like 9 to 9. Well, I mean, you can see what's happening there. 9:30 is all over here. So between 9 and 9:30, you have a lot of volatility taking place. So at 9 o'clock, if I was trading the London session, right? If I was doing that and pre-market, I'd be using an SMA. But as soon as 9 o'clock comes up, I would be trading with an EMA because I want to know. Thanks for watching this entire set, everybody. Trading reversals is a really optimal thing for your trading plan. If you're trying to catch the beginning of a pullback or know when the pullback has ended, that's where you want to get your reversals. And this indicator is going to do a really good job of showing you when they start and when they end. So stay tuned. There's just one more set in this lesson plan to watch over, and it's in the playlist. It's coming up next. Peace.